Watching Tesla shares this morning down about 1% as the company cuts prices of the Model S and the Model X for the second time this year.
And I think, there were a lot of people that were playing the stock that were waiting for a big unveil of something. We didn't expect an unveil.
Did you know that after a rough ride with Tesla in the last couple of months, and after a disappointing investor day in early March, Tesla appears to have better news these days?
The positives from Investor Day, and again, watch the 4-hour video, including Q&A, you can't help but be bullish. They reiterated a target of 20 million deliveries by 2030. That would be 24% share of the market.
Much to the delight of Tesla shareholders and enthusiasts, the company has a lot of good news to offer now. After a rough and issue-riddled several months, they deserve to receive better news. According to a recent article from the Wall Street Journal, Elon Musk's cost-cutting targets at Tesla put pressure on its EV rivals. In light of that, GM, Ford, and Volkswagen face questions about efforts to slash costs for future vehicles. Tesla recently announced its plans to cut the cost of its next generation of vehicles in half, largely by using innovative manufacturing techniques and smaller factories. According to Tesla CEO Elon Musk and other executives, the changes could bring the cost of a new generation of vehicles to around $25,000. Many investors were hoping to catch a glimpse of the next-generation vehicles, but Musk said they wouldn't be shown until a proper product unveiling. "We'd be jumping the gun if we answer your question about the new vehicles," he told an analyst. That said, although Tesla is yet to develop a $25,000 car, the company has slowly chipped away at its production costs, slashing the prices of some vehicles by thousands of dollars. Traditional manufacturers like General Motors and Ford have invested millions in electrification in recent years, but investors are skeptical they'll be able to match Tesla's cost efficiency and profitability. As many are aware, Tesla CEO Elon Musk appears to have the innate ability to put himself and the entire industry under pressure by making almost foolishly ambitious commitments. However, he knows that even if he achieves only or at least 50% of his goal, it changes the industry and gives him an enormous competitive advantage. What's better than that? Tesla scored a Baa3 rating from Moody's Investor Services for a stable outlook a couple of days ago. Moody's withdrew Tesla's former Ba1 corporate family rating, the Ba1 PD probability of default rating, and its SGL1 speculative grade liquidity rating.
Tesla's credit rating was Ba1 or junk status, according to Moody's Investor Services at the end of January. But yesterday evening, the credit rating provider upgraded the EV maker to Baa3.
The rating action reflects Moody's expectation that Tesla will remain one of the foremost manufacturers of battery electric vehicles, with an expanding global presence and very high profitability. The upgrade also incorporates governance considerations, including Tesla's prudent financial policy and management's operational track record, noted Moody's. Notably, Tesla has grown significantly since the Model 3 entered the electric vehicle market in 2017. The years after the Model 3, Tesla established a gigafactory in Shanghai and released the Model Y. Now, Tesla is ramping up production in Gigafactory Berlin and Gigafactory Texas. The company has also started producing the Semi and is expected to deliver the Cybertruck this year. Tesla's international presence is also expected to grow once again with Gigafactory Mexico, where its next-generation vehicle will be produced. It can be noted that Musk announced Tesla's plans to build a new factory in Mexico near Monterrey.
Tesla's new vehicle assembly plant will be near Monterrey, Mexico. That's according to an announcement from CEO Elon Musk.
Company executives said it will not take production from any other factories, where Tesla expects to expand production. They said the Mexican plant would build the next generation of vehicles, which also will be built at other factories. Now, what does Tesla's Baa3 rating mean? With Moody's Baa3 rating, Tesla enters investment-grade ratings. For context, Moody's rankings are split into long-term and short-term categories. A Baa3 rating belongs in the long-term category for investment-grade issuers. Further, a Baa3 rating falls under Prime 3 P3 in the short-term ratings. Short-term ratings determine the company's capacity to repay short-term obligations. A P3 rating means Moody's believes Tesla has an acceptable ability to repay short-term obligations. On the other hand, long-term ratings refer to the relative credit risk a company takes related to fixed income obligations with an original maturity of 1 year or more. That said, Tesla's BAA rating means Moody's believes the company is subject to moderate credit risks. Companies with BAA ratings are considered medium grade that might possess speculative characteristics. Note that numerical modifiers 1 through 3 are added to long-term ratings. Tesla's modifier 3 is at the lower end of the generics rating category, while the modifier 1 is at the higher end. That said, many are wondering whether Tesla stock is a buy now. As many know, Tesla is one of the largest battery electric vehicle makers in the world and is arguably the current leader in the EV industry. Notably, the company went from a startup to a globally recognized luxury automaker in less than a decade with its Model S and Model X vehicles. It competes in the entry-level luxury midsize car and crossover SUV markets with its Model 3 and Model Y vehicles. Tesla also plans to sell new vehicles over the next several years, including a light truck, a semi-truck, a sports car, and an affordable sedan and SUV. Today, Tesla aims to maintain its market leader status as EVs grow from a niche market to a mass consumer adoption. In 2022, Tesla opened 2 new factories to increase its production capacity in order to meet growing demand. What investors like about the company is that Tesla invests around 4% of its sales in research and development, focusing on improving its market-leading technology and reducing its manufacturing costs. However, Tesla bears are quick to point out that traditional automakers are beginning to invest heavily in EV development, which could result in Tesla losing market share and seeing a deceleration in sales growth due to increased competition. Some also say that EV adoption is driven largely by government initiatives, such as regulations and subsidies, which will limit long-term market growth for Tesla. Others even argue that solar panel and battery prices may decline faster than Tesla can reduce costs, resulting in little to no profits for the energy generation and storage business. Still, Tesla bulls are optimistic that the company has the potential to disrupt the automotive and power generation industries with its technology for EVs, autonomous vehicles, batteries, and solar generation systems. Further, Tesla could see higher profit margins as it reduces unit production cost over the next several years. More than that, Tesla offers the best function of any EV on the market through the combination of its industry-leading technology and unique supercharger network. So, is Tesla stock a buy? Tesla shares have risen in value so far this year. Shares trade at a price-to-earnings multiple of 55. Although that may be considered expensive, it is historically cheap for Tesla. Also, with revenue growth of 37% and a return on equity of 32%, you're paying up for quality. At any rate, Tesla stock still looks attractive, and long-term investors will likely be rewarded for buying now. Why should you buy Tesla shares today? For one, Tesla now has scale. Competition in the EV industry is starting to heat up, leading some analysts to expect near-term challenges among EV makers to match consumer demand. Tesla responded to recent pressures by announcing price cuts on some of its models. According to Reuters, the automaker slashed the sticker prices on some models by around 20%. This strategy is most evident in the Chinese market, where its cars are roughly 40% cheaper than in the US. Moreover, Tesla is profitable. In full year 2022, Tesla's operating income more than doubled to $13.7 billion. As a profitable company, Tesla has a lot of room to keep prices lower for longer to maintain and grow its market share. And it is less dependent on external financing, which is definitely a powerful advantage right now, as financing has become more expensive with the sharp rise in interest rates. That said, Tesla's valuation is still reasonable. With a market cap of $623 billion, Tesla is surely not a small company. In fact, it's worth more than every other American automaker combined. From a valuation perspective, the stock's forward price-to-earnings multiple of 48 is significantly higher than those of traditional rivals, like Ford Motor Company or General Motors, which have PEs of 7.5 and 6.7 respectively, despite large sales volume and an ambitious transition to EVs. Still, Tesla's valuation isn't as astronomical as it may seem. As a pure-play electric automaker, Tesla shouldn't be valued in the same way as traditional car companies transitioning to the technology. These companies will likely cannibalize their existing gas-powered lineups with EV alternatives, while Tesla enjoys pure growth. Tesla's relatively good growth expectations help further justify its valuation. Management expects vehicle deliveries to grow by an average compound annual growth rate (CAGR) of 50% over the long term. This could translate to significant revenue and profit growth. After soaring 58% year-to-date, Tesla stock is no longer as cheap as it was at the start of 2023, leading analysts like Morgan Stanley's Adam Jonas to conclude that investors may have missed their window of opportunity to buy the stock at a compelling valuation. But a long-term investment strategy is the key to sustainable returns in the stock market. And despite the higher price tag, Tesla still looks like a buy when considering where it could be 10 years from now. Several other analysts share this thought. Wedbush analyst Dan Ives said that a lot was riding on the fourth quarter results and 2023 guidance. While Tesla kept its 50% annual delivery growth target, Musk gave a hittable, beatable delivery target this year in the 38% growth range, which we ultimately view as conservative with the China demand picture rebounding meaningfully. I've said in a note to clients. He maintained an outperform rating on Tesla stock. His price target rose to $200 from $175 on improved visibility and demand trajectory. Mizuho analyst Vijay Rakesh maintained his buy rating and price target of $250 after the Tesla earnings report. Despite a growing number of competitors in the electric vehicle market, Rakesh said, "We believe Tesla remains the global EV leader with key advantages in its vertical integration driving stronger margins as well as self-driving technology." RBC Capital Markets analyst Tom Narayan raised his price target on Tesla stock to $223 from $168 following the earnings report. He also maintained his outperform rating. In early March, Jefferies analyst Philippe Houchot raised his price target on Tesla stock to $230 from $180 with a rating of buy. Continuous product upgrades should keep Model 3 and Y growing across traditional segments, although dynamic pricing could make growth volatile, he wrote. Make sure to subscribe to this channel for tons of Tesla stock news.